Hey Raj, I was thinking about how we all feel things, you know? Like the gasoline, it's more expensive now than it was just 6 months ago. You don't even read that, do you? You feel it at the pump, right? That little second before you look away from the number. But then on the flip side, your retirement account is green. Both of those things, they're true at the same time. And that gap between the green percentage and that little flinch at the pump, that's not a contradiction, no. It's actually the most precise measurement of exactly where we are right now.
Absolutely, Amara. I totally get that feeling, that little dissonance, you know. It's like a quiet whisper telling you something isn't quite adding up, even when the big headlines are telling a different story. It's that intuitive understanding versus the official data sheet. So when you bring up that gap, I'm listening. What exactly is the question we are sitting with today then?
Well, yeah, exactly that. So here's the question I really want to sit with today, Raj. When the official story, the one they tell us, and the experience story, the one we actually live, are running in completely opposite directions, which one is the data? Because here's what the market is pricing right now. Futures contracts, they're tied to energy costs and central bank decisions, and they're showing what traders are privately calling neurotic sensitivity. Premiums on volatility that just don't reflect a market at peace with the official stability narrative. We're told inflation is stabilizing, but the private order book, it's betting on a long tail of energy-driven shocks that haven't even hit the official ledger yet. That divergence isn't a misreading, no. That divergence is a measurement, and it's got a direction and a size, and if the structural conditions hold, a specific date by which it either resolves or, well, it tears.
Oh, wow. That's incredibly insightful, Amara. What I find really striking historically is how familiar this whole texture of the moment feels, not the specific instruments like the futures contracts or the AI governance frameworks we're talking about now, but the shape of it, the shape of a system that's learned to perform its function rather than actually execute it. There's always a moment in every institution's life cycle where the signal and the function, they just begin to diverge, where maintaining the appearance of control becomes, cheaper than exercising it. And you can feel it in the language, can't you? Active monitoring, structural resilience. These are phrases that do a great deal of work, but without actually doing any work at all, if you know what I mean.
Ooh, say more about that, Raj. Because what I'm seeing in the actual supervisory record, and this is documented, dated, specific, is that the ECB is only now beginning to formally question banks about risks from frontier AI models, risks that have been operationally active for months. The Bank of England is running scenario tests. The UK Treasury Committee has explicitly criticized delayed oversight of major AI and cloud providers. The admission is in the action, isn't it? If you're testing now, you definitely weren't governing then. It's just like performing.
Right, exactly. And the important word there, Amara, is governing, not watching. Every institution was, of course, watching. The watching was never the problem. The problem is that gap, that significant gap between observation and actual function. You can see a thing clearly, perfectly clearly, and still choose not to act, can't you? Because acting requires acknowledging that your existing framework is inadequate. And that acknowledgement, it carries a legitimacy cost that in the short run often feels more dangerous than the risk you're actually not addressing. So you perform the acknowledgement, you hold the press conference, you issue the monitoring report, and the actual exposure, it just continues to accumulate right there underneath.
Which is exactly what the Kalshi order book is reflecting back at the official narrative, isn't it? Contracts tied to recession probability and inflation targets are just showing persistent skepticism. Money betting that the relief we're seeing, it's just a suspension of gravity rather than a return to solid ground. The gap between what the institutions are saying and what the market is pricing, that's not a rounding error, Raj. It's approximately a 6-month horizon of divergence running in a direction the official narrative just hasn't acknowledged yet. And that matters because, I want to be precise here, The tools being used to manage this environment were calibrated for the problems of 6 months ago, not the problems of the next 6 months. That's not incompetence, is it? That's an incentive structure. It just feels engineered.
I see what you mean. And this is where I want to push slightly, if I may. Because the incentive structure story, it's absolutely correct, but it can sometimes become a way of letting individuals off the hook content. The incentive structure doesn't make the decisions itself. People make the decisions. What the incentive structure does is it makes the bad decision feel rational and the good decision feel heroic. And most people, most institutions, they're just not built for heroism, They are built to satisfy the conditions of their own continuation. So what you get isn't malice. You get something far more durable than malice. You get the systematic preference for the appearance of control over the actual exercise of it. And that gets replicated across every level of the hierarchy, every quarter, until that gap between the signal and the reality is so large that no single announcement can possibly close it anymore.
Wow, more durable than malice. That's chilling. And I think there's a third pressure point underneath both of those, which is like the legitimacy layer. Because the polling data right now is, it's unambiguous, isn't it? Roughly 7 in 10 people feel the system is structured to protect concentrated power while taxing ordinary productivity. And that perception, Raj, that's not like an emotional response to a bad week or anything. It is a pricing signal. It shows up in the market as low liquidity in long-durational institutional bonds. Investors just declining to lock into a system that has failed the test of proportional enforcement. The instability isn't being imported, is it? It is being generated by institutional behavior and then experienced as external pressure by everyone downstream of it. It's like a closed loop, but a really, really destructive one.
It really is. And what's interesting historically, Amara, is that this legitimacy erosion, it doesn't announce itself, It just accumulates. And then it compounds at the absolute worst possible moment, specifically at the moment of a shock, when institutional credibility is the only remaining buffer you have. The institution that spent years performing oversight rather than executing it, it discovers in the crisis that the credibility it needed to hold the room has already been spent. Not stolen, mind you, but spent in small transactions over a very long time, each one individually justifiable, but collectively catastrophic. Like 1,000 tiny cuts, eroding the very foundation.
Spent. That's such a precise word for it. Which brings me to the specific mechanism I really want to name. Because I think the AI governance situation right now, it's the most legible version of this whole dynamic. The supervisory bodies knew the risks existed, right? That's documented. They did not act because acting would require acknowledging that existing frameworks are structurally inadequate. And that acknowledgement, well, it's itself a legitimacy cost. So the apparatus just performed awareness while deferring function. And the liability that is now accumulating for everyone holding the public confidence position, the position that existing law and authority are adequate to contain AI-driven volatility, that's a potential total loss of credibility at the moment of a digital market event, before the first regulatory framework is even operational. It's like the auditors stopped asking questions, not because the questions weren't there, no, but because answering them was just too expensive.
The historical parallel that keeps occurring to me, Amara, is the period in the early 70s when the Bretton Woods architecture was visibly straining, but the institutional energy was going into defending the system rather than, redesigning it. And the reason that's useful is not because the current situation is identical, it isn't of course, but because the behavioral pattern is so recognizable, isn't it? You get increasing rigidity at exactly the moment flexibility is required. You get a consolidation of authority at exactly the moment the complexity exceeds any single authority's capacity to manage it. And the reflex, it makes perfect sense internally. When you're inside the institution, tightening the grip, well, it feels like you're maintaining order. But from outside the institution, what you're watching is just accumulated pressure with no release valve in sight. And that's truly unnerving.
Oh, that release valve question is precisely where the May timeline becomes so important.
because the next major supervisory designations for critical AI infrastructure are converging with the quarterly energy import adjustments. These are two separately accumulating pressures arriving at the exact same window. This isn't a prediction, Raj, it's a convergence of documented timelines. If the gap between announced governance and actual governance doesn't close before that window, well, the market doesn't wait for the press conference, does it? It prices the gap directly. It's just going to react.
And this is the harder truth I want to put clearly, because I think the stakes are often understated in the governance conversation, Amara. The cost of the delay, it's not linear, you know. Every single week that the official narrative and the structural reality run at different speeds is a week in which the eventual correction has to be larger and more disruptive than it needed to be. Because corrections don't only close the gap, they price in all the time the gap was allowed to persist. And they do that in conditions of reduced institutional credibility, which means the correction itself requires more coercive force and produces far less trust than it would have if it had just happened earlier. Forced stabilization, it doesn't eliminate accumulated pressure. It just converts it into a larger single event at a later date with even less capacity to manage it. It's a ticking clock, truly.
So the question isn't whether the system is stable then, is it? The system is stable, Raj, in the way a door is stable right before the hinge just goes. What we are measuring right now is the distance between the appearance of that stability and, well, the moral foundation underneath it. And that measurement, it's going to be taken, isn't it? Not by a press conference, not by a supervisory designation, but by the next shock that arrives before the governance framework is ready for it. It's like we're just waiting for the shoe to drop. And the shoe is, well, it's a big one.
That's a powerful analogy, Amara. The door and the hinge, it perfectly captures that sense of impending, structural failure hiding beneath a calm surface. So what exactly should we be watching for then as this tension builds and these timelines converge? What's the key indicator that tells us the true story?
Here is what to watch. May 15th, Raj. That's when the first critical AI supervisory designations collide with quarterly energy pricing adjustments. If the institutions use that window to provide actual proof of control, not just the signal, but the function, the market will read it as repair and behave accordingly. But if they use it to provide just another announcement, well, the order book will already know the difference. Watch what happens to volatility premiums on the week of the 15th. Not the headline, no, the premium. That's where the real vote gets cast. It's all there if you know where to look.